If you had $1 million to invest today, would you rather buy a company that pays you cold, hard cash every single quarter, or a company that keeps every penny of its profits to grow as fast as humanly possible? This is the ultimate showdown in the investing world: dividend versus growth. It's a debate that has divided Wall Street for decades, and making the wrong choice could cost you hundreds of thousands of dollars in hidden taxes or missed returns. Today, we are breaking down the hard numbers, the historical data, and the psychological traps of both strategies so you can decide exactly where your money belongs. Let's start by defining the battlefield. When you invest in a growth stock, you are buying a piece of a company that is in its prime expansion phase. Instead of giving profits back to shareholders, these companies pour their cash right back into research, development, and scaling their operations. Think of the massive tech giants that have dominated the S&P 500 over the last decade, driven by the explosive boom in cloud computing and artificial intelligence. The big advantage of growth investing is the power of pure, uninterrupted compounding. Because the company reinvests its earnings efficiently, the intrinsic value of the stock can skyrocket. You don't get a quarterly check in the mail, but your initial investment has the potential to double, triple, or even 10x over the long run. But there's a catch, and it's a big one. Growth investing relies entirely on capital appreciation. That means your gains are completely on paper until the day you decide to click that sell button. If the market crashes right when you need cash, your portfolio takes a massive hit, and you might be forced to liquidate your shares at the absolute worst time. Now let's look at the other side of the coin: dividend-focused investing. When a company matures and reaches a point where it generates more cash than it can usefully reinvest into its own operations, it starts paying out a portion of those profits directly to its shareholders. These are typically stable, blue-chip giants in sectors like consumer staples, utilities, and healthcare. Many people dismiss dividend investing as a slow, boring strategy for retirees, but the historical data tells a completely different story. According to comprehensive research from S&P Global Tracking Market Data, since 1926, dividends have contributed approximately 31% of the total return for the S&P 500, while capital appreciation made up the other 69%. Think about that. Nearly a third of all historical stock market wealth didn't come from rising stock prices, but from those steady quarterly payouts being rolled back into the market. Even more impressive is how dividend stocks handle economic storms. Take a look at the S&P 500 Dividend Aristocrats, an elite index of companies that have successfully increased their dividend payouts for at least 25 consecutive years. As of 2026, this list contains 69 high-quality companies. Historical analysis shows that since 1989, there have been 6 calendar years where the broader S&P 500 finished in negative territory. In every single one of those 6 down years, the Dividend Aristocrats outperformed the benchmark index by an astonishing average of 13.28%. In fact, in 3 of those brutal market crashes, the aristocrats still managed to produce a positive total return. This gives income investors an incredible cushion of downside protection when the broader economy goes south. So, who is dividend investing actually best for? It shines brightest for very wealthy individuals or those who are transitioning out of the workforce and need immediate cash flow to live on. Let's look at the math from the perspective of an ultra-high net worth individual. Imagine you have a $10 million portfolio. If you invest that entirely in a growth-focused fund, you might watch your net worth fluctuate wildly on paper, but you aren't getting any liquid income. To fund your lifestyle, buy a home, or travel, you have to manually sell off pieces of your portfolio every year, which systematically depletes the total number of shares you own. But if you take that same $10 million and put it into a diversified, high-quality dividend portfolio, yielding an average of 4%, You are generating $400,000 every single year in pure cash flow. The beauty of this strategy is that you never touch your underlying shares. You still own the exact same percentage of the companies, but you are effectively living off the financial rent your stocks are paying you. For the wealthy, dividends provide an ironclad stream of passive income and unparalleled peace of mind, without ever requiring them to liquidate their core wealth. However, if you are a younger investor, or someone trying to build a portfolio from scratch inside a regular taxable brokerage account, dividend investing has a massive, often invisible disadvantage: the annual tax trap. When you invest in a growth stock that doesn't pay a dividend, you don't pay a single penny in capital gains tax as long as you hold the stock. Your money compounds behind the scenes, completely untouched by the government. Dividends, on the other hand, are completely different. The moment a company deposits a dividend check into your brokerage account, it triggers a taxable event for that specific year, whether you want it to or not, and even if you immediately reinvest that cash to buy more shares. And depending on where you live, that tax hit can severely cripple your returns. In the United States, the combined average state and federal dividend tax rate sits at roughly 28.73%. If you are a high earner in the top federal tax bracket, your qualified dividends are hit with a 20% federal rate, plus an extra 3.8% net investment income tax, plus whatever your specific state levies. If your dividends are ordinary or non-qualified, like those from real estate investment trusts, they are taxed at your standard income tax rate, which can go all the way up to 37% federally. In many European nations, the tax burden on annual dividend distributions is equally harsh, meaning a massive chunk of your payout is siphoned away every 12 months. This creates a devastating phenomenon known as tax drag. Let's look at a realistic 20-year simulation to see how much this hurts. Imagine two investors, Alex and Sarah, who each start with $100,000 in a standard taxable brokerage account. Alex chooses a pure growth strategy that returns an average of 8% per year. Because his holdings pay no dividends, Alex pays $0 in taxes during the accumulation phase. His money compounds cleanly, and after 20 years, his portfolio grows to roughly $466,000. He only owes taxes when he finally decides to sell at the very end. Sarah chooses a dividend strategy that also generates an 8% total annual return, but 4% of that comes as a cash dividend which she plans to reinvest. Because Sarah is a working professional, her dividends face that average combined tax rate of 28.73%. Every single year, nearly a third of her dividend payout is stripped away by the tax man before she can buy more shares. Instead of compounding at a clean 8%, her actual after-tax growth rate drops to around 6.85%. After 20 years of this silent tax leakage, Sarah's portfolio grows to only about $374,000. Think about that. Even though both strategies achieve the exact same underlying performance of 8% per year, Sarah finishes with over $92,000 less than Alex simply because of the annual tax drag. This is why holding high-yield dividend stocks in a standard taxable account during your peak earning years can be a massive financial mistake. So, how do you bridge the gap between these two worlds? It all comes down to understanding your current financial timeline and utilizing the correct account structures. If you are in the accumulation phase of your life, meaning you are working, earning a salary, and trying to grow your nest egg as large as possible, the data strongly suggests leaning toward growth investing. If you do want to hold dividend-paying stocks for their stability, you should keep them strictly inside tax-advantaged accounts like a 401k or a Roth IRA, where those annual payouts can compound completely tax-free. On the flip side, if you are approaching retirement, or if you've already achieved a level of wealth where capital preservation and steady lifestyle funding matter more to you than chasing the next volatile tech stock, dividends become an elite financial tool. You willingly trade away the explosive upside of growth companies for the reliable, predictable cash flow of mature businesses that can sustain you through any economic environment. Ultimately, there is no single right answer. Growth investing is designed to build wealth, while dividend investing is designed to maintain and enjoy wealth. The trick to winning the game is knowing exactly which season of life you are in, protecting yourself from the annual tax trap,